Hi, I'm David Waxman of Azla Advisors. I'm here with George Cole of the Riverside Company. We're out here in sunny San Francisco at SuperInvestor USA, and just wanted to chat with George a little bit about what his fund is up to and what he expects to get out of the conference. So George, why don't you give us a couple of minutes on the Riverside Company, your strategy, and what you're looking to gain from the conference?
Sure, thank you, David. Riverside has 5 fund strategies worldwide, all focused on the lower end of the middle market, which we really define as companies with 250 million of enterprise value and below. 4 of our strategies are all control-based, classic private equity control investing. The 5th strategy, which I co-manage, is what we call Riverside Strategic Capital, and that is focused on non-control opportunities we see in the market where we use a mezzanine type instrument as our investment vehicle.
Now, we actually do a lot of private debt fundraising and fund structuring on behalf of GPs, and there's a very strong interest in the private debt space from the LP community in this current environment. When you position yourself with the LP community, are you positioning yourself as a private equity potential allocation or private debt allocation?
Yeah, it's very tricky. More often than not, we are in the private equity allocation. When you look at how we structure our funds, how many transactions or investments typically go into a portfolio, it looks a lot like private equity. We also target a much higher unleveraged return than typical mezzanine. We're usually shooting for about a 20% or 2x investment as a portfolio.
Yeah, that would certainly be much more in the private equity allocation space than the private debt space is. In this current environment, most private debt strategies are yielding sub 10%. So certainly, from our experience, you would be looked at much more for private equity play as opposed to a private debt play, due to your return targets. How have LPs responded in the current environment to your strategy?
Excuse me. Generally, pretty favorably. A lot of LP. I think when we really started, got into the fundraising for this style of investment now 10 years ago, it was tricky. We were neither fish nor fowl. I think as the LPs have gotten more sophisticated, looking for a little more stratification even within their private equity pools, and a lot of the larger LPs out there are actually creating opportunistic type pools, and oftentimes we get fitted into something like it, whether it's distressed or other opportunistic strategies. We found significantly more demand over time.
Now, how about distributions to LPs? Does your mezzanine type security have a payback date that's shorter than the typical equity type investment?
I think the distinguishing factor for us is that our, what typically Preqin and Cambridge measures DPI.
Right.
We tend to compare very favorably to classic private equity. We're often in a traditional private equity, you don't start really seeing significant returns of capital until 3-4 years into the fund. Whereas we have, through our fixed, because we have a fixed income component, we're returning capital, as early as the first 90 days of the first investment.
So you have a coupon then attached typically?
Typically, yes.
What does that range?
Anywhere from, I'd call it 8 to 14%, just depending on the transaction. We're total return driven, so we always have equity participation in our securities. We always try to end up with a balance of both fixed income with capital gains opportunity.
No, that's certainly very attractive. Now, there's been a lot of talk in the market about how effectively the mezzanine market is now kind of being swallowed up by the unitranche market. Are you seeing a bit of that, or are you able to find a strong deal flow?
Not where we play. I think what you're seeing in classic mezzanine is kind of a commoditization, and with the unitranche and BDCs encroaching on the turf. Our typical investment, we're really positioned as non-control equity. So our company has already figured out what they can do in the traditional debt market and still have that need for capital that they think they're going to need to raise, either sell their company or have someone take a control position, or sell a significant minority stake in their company for us to get involved. So we really don't see debt providers as our competition.
Right, I imagine equity is your competition, and you are providing a much less dilutive option for the managers who kind of can see some visibility on a potential exit, and they'll say, why, bring in some equity at, say, a 40% cost of capital when we could do something more at around a 20% range? Is
Absolutely.
That what
That's exactly what we're competing against. It's typically PE firms that are willing to commit and do non-control common investments.
Yeah, no, that certainly makes a lot of sense. And from our experience, again, we're talking to LPs in the private debt, in the growth equity space all the time, because that is the area that we specialize in. I'd imagine there is a pretty strong appetite for what you're doing. And one last question, I'm not sure where we are on timing, but are you focused solely in the U.S.? You're looking globally, Europe, Asia, rest of the world?
Riverside as a company has a global strategy with Asia, Europe, and North America. Our fund is predominantly North America and Europe.
Okay, great. Well, thanks very much, and look forward to hearing your panel later today.
Great. Thank you.
Thanks for joining us.